We are seeing a bit of a sharp increase in stocks today. We've got on the phone with us Marc Faber. He is calling in from Thailand. Of course, he's the editor and the publisher of the Gloom, Boom, and Doom Report. I think that says it all right there. Dr. Faber, always great to have you on the program. You know, I want to talk about something that you told us back in 2013. It was December at that time, and you told me and the rest of the traders that you expected the Fed to just continue on with quantitative easing. You thought that it would add more stimulus to the economy than it was at that time. If anything, we've seen that stimulus decline a little bit, and it seems like the U.S. market is stabilizing somewhat or adjusting to it. It's expecting to see a rate increase at some point soon. I'm curious, you know, what you think right now, and do you think that you got it wrong?
No, actually, at the end of 2013, I recommended investors to buy U.S. Treasury notes, the 10 years and the 30 years. And as you know, they've way outperformed the U.S. stock market over the last 12 months until December. Now, this year, they've performed poorly, but they're still up on the last 12 months. Now, the thing is this. In my view, there is no currency war as is being talked about. It's just central banks coordinating money printing from one central bank, the U.S., to Japan, to the Eurozone, to Britain, and so forth. And now that the dollar is so strong, and the U.S. economy, unlike what you just said, is not strengthening, but in my view is weakening, in this environment, I think the Fed will not increase interest rates this year.
Okay, listen, I want to go back to that clip specifically. I was paraphrasing there, but we do have the clip from December 17, 2013. Here's what you said. We'll talk to you on the other side.
They will never end QE for good. They will continue because these programs, once they're introduced, they usually keep on going. They may do some cosmetic adjustments, but in my view, within a few years, the asset purchases will be substantially higher than they are today.
Okay, so the asset purchases are not substantially higher than they were at that time. And we are talking about a rate rise, but it's semantics when you're talking about June or maybe later in the year, you know, which quarter it is. We know that it's coming at some point soon, as, you know, the traders have mentioned and as you yourself said. In terms of the quantitative easing program, and as you said, central banks just flooding the system with liquidity, we really are not a part of that anymore. What are your thoughts on that? How can you say that the U.S. economy is not stabilizing?
I mean, I just don't understand the word the U.S. economy stabilizing. The U.S. economy has performed worse than in other business cycle expansions, and now it looks to me as it is weakening. Now, the commentator just before me said that the Fed didn't know either. I would go as far as to say that the Fed is as clueless as I am and everybody else who listens to your program. Now, maybe you, the commentators at CNBC, know much more about the economy than I do, but I can tell you the recent figures that were published in the U.S. do not indicate a strengthening economy. And my view is that the Fed will not increase.
Which figures are you talking about? Are you talking about GDP specifically? Are you looking at unemployment figures? What's troubling you right now?
Well, I think that durable good orders were down, corporate profits were down, and the employment figures statistically have improved, but you have to look at the composition of the employment. It's mostly low-paying jobs.
Yeah, so, certainly I think a lot of economists would agree with you and say the situation isn't necessarily perfect, but it's trending where it needs to be going. Having said that, I want to switch gears and go back to something else you just said. You talked about currency, and you said that, in fact, you don't think that we're in a global currency war. At this point, the dollar is strengthening, and the gentlemen were saying that the Fed may have a problem with this. I think there are other people out there who would say the Fed isn't necessarily going to have a problem if the dollar stays within this range. How can you say that it's not really a currency war when we're seeing such dramatic volatility in the euro, in the dollar, etc.?
Yes, but you have to understand the central bankers, they talk to each other. They don't want the currency war. They have a currency agreement. So the Japanese economy is weak, and they tell the Japanese, now is your turn to print money. Then they see the European economy being weak, and they say, okay, now is your turn to stimulate. And I believe that the Fed, if the dollar stays as strong as it is now, will not increase interest rates.
It's true that the central bankers obviously talk to each other, Dr. Faber, but are you suggesting here that there's some sort of a conspiracy going on in terms of the Fed's actions, what we're seeing in the dollar, not raising rates, or do you think that the Fed is just taking a cautious approach to this?
I don't think that they know what caution is. They've been printing money essentially since the 1980s. They produced a huge Nasdaq bubble, then a huge housing bubble. Superimposed on the housing bubble, they had a commodities bubble in 2008, and now there has been a global bubble in everything, in particular in government debt, with global debt as a percent of the economy, of the global economy being at the highest level ever. So I'm not so sure about caution, the word caution among central bankers. I think they're very irresponsible, actually.
Okay, having said that, you mentioned a couple of bubbles that we've seen in the past, and you're looking at global debt as a potential bubble. Do you think equities are in bubble territory?
Well, this is a very good question, because in Europe we have below interest rates in 25% of the countries, and in 90% of the countries in the world we have near zero interest rates. So I am, say, an investor, and I invest. Do I want to buy European sovereign bonds at the negative yield, where I'm sure to lose some money, not a lot of money, but some money? Or do I want to be in some blue chip stocks? If I take a 10-year view, I think I will make more money in blue chip stocks. Equally, the question is, as you know, emerging markets and their currencies have by and large grossly underperformed the U.S. over the last few years, since, say, 2010, 2011. In some cases since 2006. Now, do I want to be in the U.S., that is an expensive market, or do I want to be in Europe, that is reasonably priced? It's not cheap exactly, but reasonably priced, and has also this liquidity injection, or in emerging markets? For the longer term, I like emerging economies, not all of them, but I think that I will make more money in emerging economies than in the U.S. in the next 10 years.
Okay, well, it sounds like you're a little bit less bearish on equities than you were then, saying that you'd want to be in blue chip names, even from a global perspective, sounds to me like you're not as gloomy as you were the last time that we spoke.
Actually, I have to tell you, I'm even more bearish than I was at the time. But I can see that if disaster strikes, and I was recently at the dinner and someone said, where are you going to hide when disaster strikes? I think in blue chip stocks you will lose less money than in sovereign bonds.
Okay, one final question to you, because you always are a proponent, as Peter Schiff is when he comes on the show, to buy gold, especially with the action that we've seen, by the Fed and whatnot. I just looked at the board. Gold right now is trading at $11.50. If you're holding gold, you haven't really done well in the last year or so. So where do you stand there?
That is correct. But don't forget, I hold my gold since the late 1990s. So compared to, say, stocks, I've done reasonably well. But I'm not as smart as some commentators are, and I don't know how exactly to buy and sell always at the right time and on the right day. So I have a diversified portfolio of assets: real estate, stocks, bonds, and precious metals. And with that, I sleep actually quite well.
Okay, Marc Faber, great to have you on the phone. As always, we will check in with you, I'm sure, later this year, see how the markets are doing, see how that gold trade is doing as well. Great to have you on the program.